Making the case for stock diversification in 2026 in this week's fastest 4 minutes in finance. Hello, I'm Scott Inman. Thanks for taking the time to check us out this week. Well, 2026 is off to a rocky start for the U.S. stock market if you measure performance by the S&P 500 index, which almost everyone does, including us because it's the simplest gauge we have. The index is up less than 1% year to date at the time of this recording, and remember the index is weighted, so the biggest companies impact performance more than the smaller companies. Well, this week we're taking a deeper dive that will show there may be a significant shift happening in the index and in the overall market. First, you're likely constantly bombarded, like I am, by negative news and social media posts that are built to alarm us. They tell us the economy is in the tank and the stock market is about to go off a cliff. So let's create some balance. According to Chris Fasciano, the chief market strategist at Commonwealth, U.S. companies as a whole are still growing. He writes that through the end of last week, roughly 75% of the companies that make up the S&P 500 have reported fourth quarter earnings. And according to FactSet data, 74% of those companies exceeded analysts' views. And because of that strength, earnings growth is on track to rise 13.2% in the last quarter of 2025. Hardly a reason to believe a stock market collapse is imminent. But at the same time, there is a shift happening. Take a look at this LPL chart. It shows all 11 sectors that make up the S&P 500 index and compares their performance in 2025 with the first few weeks of 2026. And you can see communication services and technology were the big winners last year, up 32.4% and 23.3% respectively. But this year, they've been two of the biggest losers. Instead, energy, materials, and consumer staples have led the way. According to LPL, the S&P 493, which excludes the so-called Magnificent Seven companies, is projected to grow full year 2026 earnings per share by nearly 14%, up from an estimated 10% in 2025. We've also seen improving earnings outlooks in other areas of the market like small caps and international. This makes the case for diversification and for active management. LPL tells us that while passive funds still represent 64% of all equity assets under management, demand for active equity exchange-traded funds has surged. According to J.P. Morgan Asset Management data, active U.S. equity ETFs now account for 32% of all ETF flows, up from only 6% in 2021. It's a reminder that the S&P 500 index is not the entire stock market. Simply investing in index funds may not capture the same performance as more nimbly pursuing the companies within the index and beyond that are growing faster. Working with a financial advisor can help you build an opportunistic portfolio, not just a set-it-and-forget-it strategy.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.